There's an old saying that goes, the harder you work, the luckier you get. But the thing about hard work is that it's not very fun. So it's human nature to seek out ways to get rich quick. Today, we're going to talk about how that relates to Coinbase stock. And we're going to start with something that you may have seen in the news. We've titled this slide Absolute Lunacy because that's what it is. There was a cryptocurrency called Luna. It's a stable coin, and it's not necessary really that you understand any of this, because I can guarantee you that nobody that invested in this debacle understood even an iota of what was happening. So here's an ad that we pulled, and it said, earn interest on Luna on Binance. That's a crypto exchange that has some of its own problems. But the appeal here is that if you put money in for 90 days, you get close to 19% interest rate. Now, anybody looking at this with the modicum of common sense would smell a rat. So money isn't free, nothing's free. You can see down here it said no UK or EU investor protection. Well, all the people that put their money into this, and there was an awful lot of them, are all posting suicide notes over on Reddit. That's no joke. So there's a whole bunch of them that are lost their life savings and all these other horror stories about instead of accepting some responsibility for their incorrect decisions, now it's posting notes on Reddit. Interestingly enough, people that commit suicide, most that talk about it don't do it. So take that for what it's worth. But this absolutely blew up, and it's no surprise whatsoever. We wrote late last year, about the danger of stable coins, and this was mimicked by Janet Yellen around the same time, who said that these actually posed a systemic threat to the US economy. Now, I don't know if you would take it that far, but if you have the time, read this piece. I'll put it in the description of this video. It's incredible. You couldn't make this stuff up. So there's a stable coin called Tether. And I'll just ask you this: in what situation would anyone deem it appropriate to hand over $75 billion to a handful of individuals who refuse to audit their financial statements and use attestations instead? When would that be considered acceptable? Well, that's what's going on with Tether. And there have been a lot of concerns, notable individuals in the crypto community saying this is an extremely large systemic risk to the entire cryptocurrency industry. Now, here's a couple tweets from the CTO of Tether. He's in Lugano. So that picture there on the left, that's taken on the shores of, not sure the lake that is there, but I was just in Lugano a couple days ago passing by here. And I can tell you this is one of the most expensive places around. So he's managed to park himself in a place where it costs a lot of money to live. Certainly not where I would found a company, but he's sitting there, and you can see on the right-hand side, there's another tweet that he put up 3 days ago that uses the language of the crypto bulls and this sort of cult language they use to describe why everybody ought to be pissing away their money on an extremely risky set of asset classes. Now, there could be other reasons why this gentleman is in Switzerland, and you can probably, if you have any sort of knowledge of why people go to Switzerland, particularly individuals in dubious aspects of finance, then the whole thing just reeks. And you can go and read that article, and it talks specifically about how bad this setup is. Now, what you can see happened here is when there was some panic around Luna, the price of Tether, which is a stable coin, so it's supposed to always equal a dollar. Well, for a while there, it didn't equal a dollar, it equaled 94 cents. What would happen there is that individuals who trust this always equals a dollar, meaning it is backed by a US dollar, would step in and buy at 94 cents because that's arbitrage. If it's worth a dollar, you should be able to sell it for a dollar in the future. So that appears to be what happened here. So the individual investors, whether they're institutional or retail, stepped in and perked the price back up. The fact that it even fell and that confidence was lost, they said that they had gone through about $3 billion worth of liquidations on 75 billion, and that they're starting to trim their commercial paper holdings, which they won't tell anybody where that commercial paper exposure lies, whether or not it's in risky Chinese assets. The whole thing is an opaque mess, and it should be avoided like the plague. Now, let's talk a little bit about Coinbase now that we've covered why the entire crypto world is going through a bit of an earthquake right now. So what does Coinbase do? And we've covered this firm in a number of research pieces in the past, and it's very simply this. You can see here around 88% of their revenues come from retail investors, retail crypto investors of the type that created the mess that you saw with Luna. So these are not individuals that invest wisely. You can see that institutions, even though Coinbase wants to talk about how much volume they're seeing from institutions, look at how small the percentage of revenues is coming from institutions. It's minuscule. So just because they claim to have all this institutional money flowing onto their platform doesn't mean anything. We've also highlighted under the other here. So they say total subscription and services revenue, blockchain rewards. This is for staking. Again, the same sort of behavior that you saw with Luna that created those problems. So if you stake, you promise not to touch your money, then they give you a return. And I'm not sure what Ethereum is staking at right now, but certainly wouldn't be anything that we would want to get involved with. So you can see here that over the years, Coinbase, this is they're taken from their 10K, Coinbase has seen retail revenues just go through the roof. Well, that's very quickly changing. So last earnings call, when the stock price reached, I would imagine it was new lows somewhere in the high 40s, I think, per share. What happened in their earnings call, they missed their revenue mark. So I think Refinitiv was saying they come in at 1.48 billion. They missed that by 21%, 1.17. Transaction revenues fell 34% year over year. That's both on the retail side and institutional side. Usage on their platform fell in terms of active users, down 19%, volume down 43%, and the firm had a net loss of $430 million. That's the wrong trend that we want to see a firm going when capital is drying up. And then we noted over $1 billion in crypto investments on their balance sheet. Now, that last point is a problem. It doesn't matter whether or not they make money on those investments. What matters is that they're taking a punt on things that they shouldn't. They should be running a pick and shovel platform for the cryptocurrency industry and not speculating on risky crypto assets. We've written a piece before, and I'll put a link to that in the description of this video, that talks about why firms shouldn't hold Bitcoin on their balance sheet, or SPACs, or whatever other thing that they decide, the company management decides they want to take a punt on. So earnings didn't go that well for Coinbase. Now, another thing that happened around the time that they had their earnings was this gentleman here. We're going to caveat this by saying this gentleman should be given a big round of applause for having the spine to say that he would not allow politics in his workplace, and kicking to the curb the small 6% of troublemakers that wanted to create problems in his organization by bringing in their political beliefs. So good job, Brian Armstrong. So he was on Twitter here posting about a disclosure that was made to the SEC that says, and you could just read it for yourselves, a court may, and he uses the term however unlikely, which is that's no reassurance. However unlikely, a court would decide to consider customer assets as part of the company in bankruptcy proceedings, even if it harmed consumers. And he says we should have updated our retail terms sooner. The point is that if this firm goes bust for whatever reason, so does potentially your money, however unlikely. That's, again, no reassurance. And we do have some money on this platform, and we'll talk about that. So the only bets that we've made around cryptocurrency were on Bitcoin. That was largely based on a piece that we published looking at ARK's thesis around Bitcoin being digital gold. The diversification aspects of this mechanism were appealing. So we made a bet on Bitcoin. Our average purchase price was around 7,800. Our average sale price was around 41,907. I know these numbers exactly because I pulled the report prior to doing this video. And what had happened, I wasn't unaware of this. We actually covered our initial capital. So all the money that we put in, we've covered that, plus 7% return. So right now we're playing with the house's money. Now you need to be careful about what they call the house money effect, which means suddenly your decision-making capabilities change a lot because you're playing with house money. So right now we're holding Bitcoin as about 1% of our assets under management. So it's a very small amount relative to the total money we're managing. And you can see on the right here, I logged in just before this call to check on some prices of our position. And it said we're having connection issues. We're looking into it right now. Please try again later. And of course, your funds are safe. So I guess that goes to show that this entire thing, the entire cryptocurrency industry, is not regulated. Decentralization may be one of its worst enemies. It's something that's very new and very difficult. And some of the horror stories that you hear out there, aside from Luna that we mentioned earlier, it's just unbelievable that things like that can happen. You can have a notable Web 3.0 startup say that they just lost $300 million and nobody bats an eyelid. It just is best avoided. The last thing I'll say about betting on Bitcoin is that a piece by Barron's said it's about 70% correlated to coin. So the way that correlation works is you take the returns of two assets, ideally as granular as possible, and then you can run some algos against that, and it'll show you how the two assets move together. So if an asset is correlated 1-to-1, you're getting the same exposure, but from both assets. And this is highly exposed. Bitcoin is highly exposed to Coinbase stock with a 70% correlation. So we get some of that exposure without actually having to deal with the company specific risk. Now, the problem is that we're actually holding our exposure on their platform. So that kind of mucks it up a little bit there. But at any rate, we've always felt that Bitcoin investing was best done on Coinbase platform because they're publicly traded. You certainly don't want to get involved in Binance. By the way, the folks behind Tether run the Binance exchange, so we'd avoid that like the plague. So that's a little bit there. Now, getting rich quick, we want to touch on this. The clickbait headline was meant to shine some light on the mentality of the crypto investor. Now, here's something interesting. Fidelity once took a look at all their brokerage accounts to try and figure out which retail investors were able to beat the market. Incredibly, they found that the highest performing accounts were those that the owner of the account died or forgot they had an account. So getting rich, you can get rich quite quickly. Take your money, invest it in 99.95% of it in broad market equity ETFs. It'll take you 5 minutes. Just go buy Vanguard. They're the cheapest. Buy them up, put 0.05% in Coinbase stock, and you can join the ranks of the wealthy with that 5-minute commitment. The only thing is you got to wait 30 years to start spending the money. So do that, and you can be rich quick. So the conclusion here really is that the average crypto investor who you have a lot of exposure to through a Coinbase investment is not the sharpest knife in the drawer. And right now you're at what, 88% exposure to retail right now. That has to change. So Coinbase, we've always looked at it as a desirable pick and shovel play on crypto, but they need to have diversified revenue streams. That other category just isn't growing fast enough, and it doesn't seem to be growing in the right area. So staking isn't necessarily something that, and we've written a piece on Ethereum. I'll link to that in the description too, which talks about that whole aspect of staking. So for now and going forward, we're avoiding Coinbase at any price. We're not going to cover it. We're not going to focus on it until that revenue exposure changes and they move away from the retail investor. So please put your comments in the comment section. Subscribe to our channel, and thanks so much for taking the time to watch this video today.